Would you, let me ask you this. In today's high inflation chaos and volatile markets, would you invest $67,500 now to collect $888.83 a month for 20 years? That's $10,000 per year, secured by real collateral. You're not buying a rental. You're becoming the bank. This is a first lien amortized note, not speculation. It's property-backed cash flow. While non-cash assets wobble, our investors are stacking predictable legacy income, one secured note at a time. That's mobile mailbox money. Visit our site to start building real wealth.
Okay, of course, a funny video pops up after that. Hey, everyone, welcome to Mobile Mailbox Money. This is our mastermind here that we do weekly every Thursday at 12 o'clock Arizona time. What do we do out in the market? Well, we help capital investors secure collateralized lending opportunities in first and second lien positions, some bailout loans, fix and flip strategies for short-term lending, as well as full 20-year amortization of seller finance notes. Today's brought to you by Silvercrest Opportunity Fund. Invest accredited and earn a 10% net return for terms as low as 1 year. Investing accredited like Warren Buffett in our 506c 3C1 Silvercrest Opportunity Fund. We've got our partners here today. We're excited at procuring double-digit interest collateralized lending opportunities for our capital investors. Today, just quick house cleaning this week. What have we been doing this week? On Monday, we went to Arizona Real Estate Investors Association, as seen on my blog, Mobile Mailbox Money. Caught up with Tommy D, prolific developer, also another mortgage lender, seeing some trends in investment loans, as well as getting data and analysis from the Cromford Report and Tina Tambor, the senior housing analyst of Cromford for Arizona Real Estate Health, providing us the data and analysis we need in order to move forward in a strategy or to a pivot point or even in a niche that possibly weren't originally anticipating. Well, you got to be nimble with the market, be out and touch shoulders with people you know, like, and trust, and build strategies that perform in up and down markets. Well, what is that? That's being a lender and becoming the bank and collateralized lending opportunities in first lien position and some second lien bailout loans, providing sufficient equity cushion for a capital investor to feel comfortable, safe, stable, and secure outside the stock market. Donald Trump just passed an executive order providing capital investors with large money in 401k accounts to start investing in alternative assets. Well, what does that mean for us here today at Mobile Mailbox Money? That means that you can soon retirement save your way to financial freedom, investing in alternative investments with your 401k. It no longer has to be just IRA investing and custodianizing that with a self-direction elected qualified product. Now it can be done through a 401k. And the need for alternative investments is higher than ever. So I've got our partners here today, Jason Roberts in the Florida market. We prefaced this Mobile Mailbox Money Mastermind today on the short-term fix and flip lending strategies that we procure out in the market, providing the lien position and a qualified operator out in the market. So Jason, appreciate having you on the channel and on the team. If you could just talk lightly, we'll talk the next 20-30 minutes actually about these fix and flip strategies. Why are these important? Well, you know, investors don't always want a 10-20 year term. I'm talking to a lot of investors even today. They're like, man, you know, a lot of the competitive strategies, they're wrapping you up for 5 years, 10 years, a note's 20 years. Well, here's your opportunity today to start lending in a short-term capacity at, you know, sufficient equity cushion and qualified operators. Jason, how's it going today?
Good. How are you, sir?
Doing great. Thanks so much for being here and being a part of the team here, providing bank quality stability outside the stock market. What do we got on the plate for today?
Yeah, I mean, one of the things that we are always trying to do is obviously find niche markets that create a great income, where you can buy at a really good price, but create some cash flow. And, states like Arizona, Phoenix is specifically Florida is one of those places where it's been very, very hard to find deals that cash flow. The 1% rule really does not apply in states like Florida and Arizona. So you've got to look, you got to have somebody on the ground, boots on the ground, looking for deals and, creating that volume that gives you an opportunity to lend or to buy a property at a great price that gives you the cash flow that you're looking for. Now, what we're talking about today, obviously, a lot of folks don't even understand the lending that you can get involved with on the short-term side of it for either fix and flips. Even if it's a rental property, a lot of times houses need to be purchased. They need to be rehabbed before the exit strategy, can even be implemented. Now, whether that's, what we call a fix and flip, where you're buying it wholesale, you're fixing it up, you turn around, and you're reselling it for a profit. That's one way. And there's typically real good equity in those, for protection, purposes. But another niche market that we know of is obviously mobile homes is a very good cash flowing asset. We focus in Florida, in places where we also own the land. So we've got a few things that we have to worry about that other folks in different parts of the country don't need to worry about. And so we are very driven by finding deals that, if a catastrophic event comes through, we still have the ability to cash flow an asset. And one of the things we've been talking about for several months is these unique mobile home retirement places, in parks where you own the land. And the HOAs are, what we're going to talk about today. We're talking about HOAs in the $140 a month range, and you've got access to everything that you want in a condo situation or traditional mobile home parks. You've got, for older folks, you got pools and you got racquetball, or you got, the big events like bingo halls and, the things that those folks are looking forward to do on a daily or nightly basis. And we are coming across some just really, really good deals, in that niche. Now, if you don't mind, can I show some pictures?
Yeah, go ahead. Let's give them back office view. Let our investors walk through the back door of cherry-picked golden nugget opportunities. Remember, you're a lender. You're not buying this to operate it. You're partnering with qualified operators in a lending capacity.
Yes, sir. Yeah, so this is an example of one of the unique properties that we're really, really looking forward. This is you can see by the pictures. I'll go through them right here. This is a mobile home, with a patio attached to it. A great looking property. It needs minor rehab, which we'll take care of. These are retirement type properties that have access to all of the amenities that somebody in their 70s or 80s is looking for. And this, just real quickly, this is a picture of one of the properties. Now, this specific house, we're buying this house, and this property also comes with an extra lot. So we've got one cash flowing asset that we can rent with a house on it, and the other one, the lot that we're buying in this transaction, we can also put an RV on it, and we can do Airbnb rentals, we can do short-term rentals, we can do long-term rentals, we can add a house to it, if we want to, and owner finance it, rent to own it. But the point is, from a short duration standpoint, we can borrow money, over, let's say, a 6-month or a year period. We can buy the property, we can renovate it, we can get it ready for whatever the exit strategy is. And I know you guys have got folks that, they really want longer term stuff. This is a shorter term, but we may be able to convert them into a longer term note where we've sold the thing, to an end buyer, for example. But you could see this is a very good example of what we're talking about, where we're buying this whole property along with another lot for $100,000. And again, that's a heck of a deal in Florida. In Ohio, it may not be, but it's a great deal in Florida. We are going to convert this if we need to into a second bedroom, or if it's a couple and they only need one bathroom and bedroom, then we'll leave this, as it is. We'll fix up the issues that need to be fixed up. It doesn't need a whole lot of work. I think the rehab on this one is less than 10 grand. Typically you're talking about air conditioners, things like that, but we're going to be able to rent this house alone, not the lot, but this house alone. In terms of an Airbnb rental, those numbers are a lot higher than what I'm going to tell you, but the peak season rental is about $1,500 a month. So for about 6 months, we can rent this for $1,600 a month. We can Airbnb it the other 6 months. We also are getting another lot that we can park an RV on, or somebody will rent that lot from us in the peak season for $900 a month. And so for $1,000 or for $100,000, we are going to be somewhere in the range of about $2,300 to $400 a month in income on both these properties. So where else are you going to find a deal like that? And we have this property is really considered 2 different properties. We have 3 other properties just like this in this area that we are under contract on right now.
And what leverage are we seeking?
I mean, typically we're trying to be under 70% or so, right? Just to keep our funding partners, in a good position. So, we could, to be honest with you, we could borrow the entire amount we could borrow 100, the purchase price and the amount, to rehab the house. The lot is ready to go. And our debt coverage ratio would be something like 2 to 2.5 times.
So is that 150,000 to position the both? Maybe they get 100 on the unit at $1,000 a month and 50,000 on the other as we improve and provide additional improvements.
I'd say we'll end up borrowing about, let's call it 70,000 on the house structure, and let's call it 30 or 40,000 on the lot, just to cover both. So you're talking about an all-in position for both, again, because this is one seller. They are 2 different transactions, but we're talking about borrowing roughly $110,000 on a property that is probably worth, the value of each lot is $51,000. So we are buying the house and the lot for cheaper than just the lot price.
Right. So that's 110 at $916 a month, paid monthly for a term of 1 year, and that will probably mature within 6 months. Because the market demand facilitates early exit. We have nimble strategy and the availability to refinance you out. Why? Because it's a real property asset opposed to it being just the personal property unit. So nimble exits, providing stability to your liquidity moment, possibly even within a 6-month period. We'll probably draft it as a year just out of convenience so we don't have to tap our lender again. But our objective is to get you paid off if you're looking for a short-term program, or even better, as we exit or rent it, we may offer you a longer-term position at that point for the lender. So, nimbleness within that double position, to perform in a qualified operation hedged with a passive lending and first lien position. First lien, only lien on those properties. Golden nugget for sure.
Absolutely.
$916 a month for 110, 1 year today. Wire ready opportunity. You could buy this position right now.
Yeah, and I've gone through some of the pictures. You can tell that the hall here is like, that's the event. The folks that rent in this park, the event is every night there's something going on in that hall, whether it's bingo or dinner or whatever it is, and it's a lifestyle. and they all want to be within walking distance of those activities. And like I said, this is a niche that we have. I think we have 5 properties just like the one we mentioned that we are under contract with or in the middle of due diligence, something along those lines. So there's a huge opportunity to run one from a leverage standpoint, because the value is, we're buying these at such cheap prices that the value is there. So the loan to value is terrific, but the cash flow to loan value is unreal.
Yeah, the return capabilities are not able to be matched really in any other asset class. In other words, cash flowing with less for more.
Hey, Jason, quick question. On the double lot, what's the monthly or what's the HOA dues? And is that a double HOA due? And is it due monthly or is it annual? Do you know?
The HOA is 140 a month, and each lot it is due for each lot. So it's 140 per lot. In that case, you'd be at 280 for both. But like, the one thing that we aren't sure about, to be honest with you, if we just rent this thing for the high peak of 4 months and Airbnb it the rest of the time, there are folks getting $2,000 a month. So there's a ton of exit strategies on these type of deals. It's always better when there's just not one thing you can do. So we can do multiple things in this scenario, but the key is that we are buying it at a great price, and the cash flow that it'll produce more than covers, the debt service.
Okay.
But although we were talking about earlier, you're looking for more short-term loans, and so this is an example of one. But folks can jump into the traditional fix and flip business if they're looking for higher yields, maybe, and shorter time frames. We've got a ton of opportunities with traditional, single family housing, where they could get involved on the fix and flip side of things. So you're talking about, 5 to 7 or 8, 9 months in some cases. And they get their money back and they can roll it right into the next, property. And we have many of those opportunities every single month.
Let's pull one of those up real quick. Do you have the capability of doing so? Let's pull out a golden nugget here.
All right, give me a sec.
If I can formulate my words today.
Yeah, let's see here. What do I got that's available? I got all these houses loaded right here. I get rid of that.
Now's the time to buy. Listen, people were waiting for Jerome Powell to reduce interest rates, and they say the minute that he does that, people are going to start kind of coming out the woodwork. Out of hardship and uncertainty comes opportunity, and finding qualified operators right now, and not having to go out and take the brunt and responsibility of meeting with contractors, meeting with real estate agents, or even have the know-how, in order to do all the above, now may be one of the better times in history to be doing so, because the new institutional appetite in single family properties is going to keep them high. Interest rates have crept up from a historic low. Now's really the time to make a move.
I'm going to share my screen again, if that's okay.
Go ahead.
All right, this is an example of one that we just closed. This property is in Stark, Florida. And and again, typically the purchase prices that we're getting these things for, you're not going to see these advertised publicly. But this property is we're buying this for $80,000. We've got multiple strategies on this one as well. So you can see a picture of the front. It's a block home, traditional block home. And more than likely, the goal is this is either going to become a rental, or it's going to become an owner financing project. Now, comps on this property are about 230 to 240 when it's fixed up. If we end up doing the rental strategy, we're talking about putting about 45,000 into it. We're buying it for 80, so we're all in at 125 on a property that, from a rental standpoint, is probably worth 200 at that point. If we're going to do a full-blown owner finance, rehab or fix and flip scenario, and again, this has got multiple options, but we're buying it for 80 grand. We're going to put probably 65 to 70,000 into it as a retail situation, and it's worth 230 to 240, either as an owner financing contract that could convert from a short-term contract to a long-term, hold for folks that want it. So like I said, the key is to get just having a scalable lead flow of deals. And we have deals in Florida, Texas, Georgia, North Carolina, and other states that we don't actually fix and flip, but we do create notes on, where yields are really, really good. There's a ton of equity on them. We're just not rehabbing the properties. So this is a great example of, hey, we're buying a property that's got multiple exit strategies, got really good loan to value when it's all said and done. And, so the investor's protected with, in worst case scenario, you'd either just sell it and get rid of it. You sell it to a landlord if you don't want to hold it and rent it yourself. And, there's going to be a real good positive cash flow on this. Because you're talking about, rental of 1900 and a payment. I'm not sure what the payment would be on that, but, definitely the payment's not anywhere close to that.
On 150,000 for 1 year. Oh, whoops. Typed this in wrong. 150,000 is just below 70% loan to value at a double-digit interest rate for a monthly payment of $1,250 a month, interest only for a 1 year term, and that'll mature within the 1 year, probably 6 to 8 months. And we'll give you an option possibly of a first right of refusal for a longer term play, possibly another liquidity moment in a year. Super nimble.
Absolutely.
So we've talked to a couple investors, a concern they've had is insurance, and we're validating those positions. Us being in the business that we're in and insuring our interests is of utmost importance, because, the longevity of that position and risk mitigation is always of conversation. Everyone talks about wanting to make the most money, but the thing that's most important is not losing any. At the end of the day, to preserve capital. It's all fun and games when you go to a 2x equity multifamily syndication play, but when interest rates hike, at the end of the day, you are wanting something that provides a 20% return a year, and you may lose all your money at the end of the day. So to provide a stability, a double-digit interest rate, out in the market, and a monthly income, is virtually non-existent at these returns. As when you go to the stock market, your account's going up at the end of the day, but really, how are you getting paid? Are you pulling profit monthly? Are you getting distributions monthly? And is that return fluctuating? I think a lot of people are scared on the sidelines, like I said, waiting for Jerome Powell to reduce interest rates and not wanting to invest in the stock market or low yield mutual funds and bonds. And they're just sitting liquid. These are the positions and where it fits within your portfolio. If that's the case, if you're watching here today and have money in that accord in that section of your portfolio, this may be an avenue for you. Sufficient equity cushion, and what Jason, sorry, how many deals have you guys done?
Oh man, over a lifetime?
Let's get lifetime numbers.
Okay. We have done over 1,200 actual fix and flips, and another 1,100 others, right? Multifamily, that kind of thing. So we're well into the 2000s over the 30-year history, and that would include probably 23 or 24 states.
James, how many properties do you think you've been in and out of?
Not that many, not as many as he had, but probably 1,500. He's in the 2000s. He got me beat.
I don't know, not by much.
And we here at Win Mobile Homes, Mobile Mailbox Money, and Silvercrest Opportunity Fund have done over 300 deals in the past 8 years. So, we're trucking along, seasoned professionals. In other words, this is not a first time around. This is literally a backdoor view of individuals who've done probably $100 million worth of deals or more, literally. So to provide this out on a public platform literally may be a dumb thing to do. Some people think. They tell us not to put out this information, to hoard that as close as possible, but we're looking for other individuals to help us grow the opportunity. And how do you do that? You put out valuable and unfiltered information. These are the golden nuggets, literally not seen anywhere else in the marketplace. And I see another individual that joined here. Appreciate you being here today. So this will go out on all public platforms, and a tremendous amount of deals. Jason, how many deals do you guys think are coming across your desk a month right now?
Well, it depends on, like, there's multiple different types of deals, so like from a note standpoint, right now, there's so many folks out there that bought their house 20 years ago, refinanced their house in 2002 when the interest rates were 2.5%, 3%, had some kind of an event happen where they're not able to make their payment for a little bit. So they're in their property at 40, maybe 50% loan to value now, but it's in foreclosure. They've got enough equity in it that they obviously don't want to lose their equity. You don't want to strip your equity from them. So we are getting some serious opportunities where folks just need an equity loan, so to speak. And, that number, we don't really market to that aspect of it because we're marketing to folks. Obviously, we're in a real estate investment company, so we're marketing to folks, hey, we'll buy your house, right? And this is a byproduct of it. And we could probably do 50 or 60 loans a month, it just in that segment alone. We've got an apartment complex in Houston, Texas under contract. That's $15 million just right there, 250 unit complex. So that's obviously a different set of folks. We have our own fix and flip business in multiple states. That's, a different type of strategy for some folks. So literally, if you want to be in the real estate space, we've got a lot of deals. You mentioned something a second ago, which I love that you bring this up because you do not hear this from other gurus. What do you do about insurance in Florida? That's a real question. And if somebody asked me about, oh, sorry. If somebody asked me that direct question about, for example, the property I just showed, we are buying 2 lots that are worth $104,000 without the houses. So in the situation where a hurricane comes through and wipes away everything but the land, right? We still have 2 assets from that one purchase that are worth more than we paid for it, and still produce $1,800 a month in rentable income. So worst case scenario, we have a season where 3 hurricanes just blow through us, right? We are still buying an asset at a price point that is cheaper than the land is worth, that produces cash flow that would be quite a bit higher than what the payment's going to be. So how do you protect somebody outside of that? Well, you get insurance, of course, but we're buying at the right prices. I'd love to have a conversation about multifamily someday, because what we saw in 2002 and 3 was, I couldn't believe what we were seeing, and people jumping in on board with some of these big time gurus who were pitching, oh, you can make this and you can make that and guaranteeing rates and all. And now those folks are lucky if they get anything on a month or quarterly basis because they just paid too much. They didn't pay attention to the price of the asset. They jumped in because interest rates for 4% on multifamily, and they thought it would be like that for the rest of their lives. Well, then they jumped to 7, 7.5, 8, and now that asset that they overpaid for is not producing enough cash flow to make the payment.
Hey, Jason, I'd like for you to step back just a minute and readjust that conversation about Florida and the worst case scenario component, because we get that a tremendous amount of time in conversation. And it's really kind of a very interesting, almost eye-opening breath of fresh air, understanding that if the worst case scenario happened, we are only taking on inventory that fits specific model, or a lot of the inventory that we're taking on, we have a solution for it because we're prepared for that. So can you roll back through that on Florida?
Yeah, and it's not just Florida. Now, Florida, like I said earlier, Florida's got some specific problems that the rest of the country, outside of maybe Houston or New Orleans, places like that.
Brakes are bad.
Nobody gets hit by hurricane.
Got an accident.
Oops. So yeah, we have to deal with hurricane damage. Now, other places around the country, they got tornadoes, and so you've got issues like that. Insurance, I mean, at Florida for the past 30 or 40 years always goes through an insurance crutch where you get hit by a few storms and it creates a lot of damage, and insurance companies bow out for a while and then they always come back. And now they're starting to come back. So it's not like we're not going to have insurance, right? We're going to get insurance. My point was, we're buying these assets at land value in a lot of cases, so even in a worst case scenario where you got wiped out totally, you still have the land, you still own the land. And in these places, short-term wise, we would convert the lot into, something along the lines of the folks that need to place to park their RV while they're working on storm damage, right? Guess what that rental is? That's
Right.
only $1,500-$1,600 a month per lot, right? You stick an RV on that lot, and now instead of the $900 a month you're getting just for the lot, you're getting $1,500, $1,600, $1,700, because FEMA's coming in and parking their RVs on the lot and paying you, rent. So nothing is completely foolproof, right? Nothing is. But for the purpose of specifically discussing insurance, we're buying these at such great prices that the cash flow will cover the asset in the case of a complete wipeout of the actual property.
Somebody could be listening to this and saying, I just want to do the strategy because I know a hurricane's going to come. And I understand government contracts like FEMA and so forth. I'm going to get $4,000 to $5,000 a month for my lot when that specifically happens. So I'm already prepared. I know where the temporary manufactured homes are, the trailers, already have the contact set up. I'm just really sitting back. I'm playing the hedge. It's almost like you're on the come out line on a craps table. Are you going to play the pass line or no pass? Somebody could actually say, well, I'm just going to play the hurricane line, which is I'm going to rent it for a reasonable price right now. If something gets wiped out in the area, I'm going to make arrangements with my contacts to capitalize on the need for livable environments while the area is having to rebuild and redevelop. And that's actually an interesting strategy and a really good strategy to talk about, because nobody thinks about that. Because normally it's like deer in the headlights. A hurricane comes in, blows over, and everybody's just stuck. They're like, I don't know what to do. I knew it could happen, but that's a nightmare situation. Now I'm in a nightmare situation. I don't know what to do. I just got to call my insurance company, and I'm going to wait months and years for them to get back with me. And I've got issues. Where if somebody had a proactive stance on, okay, if that happens, we go to plan B. Here's the exact plan B. I already have the companies to call to bring in modified trailers. I already got an understanding. The HOA understands it, or whatever, the park understands it. We're going to bring in temporary housing on the 2 lots and get them hooked up immediately and make them available for government contracts first, or insurance contracts. I mean, insurance is going to pay 2 to 3 to 4 times the money because they've just got to have a place for put these people in. Interesting conversation.
Absolutely. I mean, that's just another protection, that most people don't talk about or don't understand. But if you can buy, I mean, what we're talking about is we're buying a house at lot value, but it's got a house on it already. So worst case scenario is storm has to come through, take the house out for you to end up doing the FEMA side of it. Now, do we want that to happen? No, but a lot of people don't understand that when a storm comes through, a ton of money flows into that area because of the damage and the work and the crews that go down there. They all got to have a place to stay.
Right.
So it's a great opportunity.
So in other words, in short, we have an exit strategy for all the above. We have an insured position. We have exit for, let's say hypothetically that unit were to get wiped off the lot. We have a rental exit. We have a seller finance exit. We have a fix and flip exit. You know,
Airbnb.
shoot, man, how many different ways can we flop this turkey?
Flop the turkey.
Now I'm hungry.
Now I'm hooked.
That's fix and flip loans, short-term financing. We touched lightly on bailout loan programs. What's a bailout loan? Bailout loan, high equity upside. Individual has a 3% mortgage, literal gold out in the marketplace, and they have, say, with new debt, it's less than 60% loan to value. With the new debt, we originate those positions at an 18% interest rate for 3 years, as that's what we're available to do. It's strictly an equity-based loan. We're hedging on the assets appraised value. So that's value out in the market, 40% picked up if that borrower goes non-performing. Our objective is not to foreclose the house. We came into it wanting to buy the property they didn't want to sell, so backed into the acquisition via an equity-based loan on a second position, no more than 60% loan to value. So we're hypothecating those positions at a 1-year term. Let's say we had one today, and we may pull one up here in a sec at $50,000, which they're about 25 to 60,000, and this is on a 1 or to 3-year term. And we're talking about introducing this into the fund, providing more stability to our investors. But say hypothetically, just at a $50,000 benchmark on average, we're looking for passive lenders at a 1 or 3-year program. The 1 year is currently paying a monthly payment of $416.66 a month for 1-year term with qualified operators, and we pledge the lien position in order to garnish capital investment. That's what we call hypothecation as the definition. And for a 3-year term, you know, we could increase that monthly payment on $50K for a 3-year term at a double-digit interest rate, increased from the previous because you're taking a little bit longer of a term. It's $500 a month. Is that right?
So Jason, as he's doing that and talking about that, maybe you can go back and if you have anything that you can post up on the screen, and we'll talk a little bit more about what a second is and the value and the perspective risks associated, obviously how you're setting up closing in the lien position. And I'm happy to help you provide additional color and information in regards to that. But I think that walking through somebody on this right now, so as we send this out, they can listen to it a couple different times. What is a second lien position? What is the average debt to income? Not debt to income, but debt to the total value of the property, and how the protection comes into play in the lien.
And Rodney, key in on this. You know, these are positions at 20 to 50,000 bucks, maybe a little bit more, maybe a little bit less. But you know, this diversification capability at a lower than traditional acquisition cost, you know, we can still provide a pretty attractive rate on an interest only payment. So, you know, key in. Happy to have you here today too, by the way.
Okay, sounds interesting.
Yeah, this is a property. This is a great example of one we've got on the board right now. These come about because of our outreach marketing. We do it in many states, and this person came to us because they were looking to sell. You can see that the property is listed for 230. It's not worth 230 in this current market for purposes of retail. There's a lot of competition. This lady that came to us, which is, I mean, it's just a great story. This was the house she grew up in. She owns another house. On this house, she owes 50 grand. She spent another 30 grand on her credit cards fixing it up. And is kind of behind on her credit cards, but she's got a great, really low, I think it's 2.75% mortgage on the first. So it's a mortgage you just don't really want to sell, right? You need, whenever you can get a hold of something like that, you keep it because you can build long-term wealth from it. So she was panicked, like, I got to sell it. We're talking about numbers with her, like, I don't think it's worth 230. We think it's worth about 210 in the current market to sell it immediately. Here's what our offer would be, but we talked her out of doing it. What we ended up doing with her was we just said, why don't we lend you the 30 grand to pay off your credit cards? Right. And that's like Alden said, it's at 18%. She knows that, but she's got 30 grand in credit card debt that she's paying 29 and 30%. She's got about 15,000 or 1,500 a month going out just to pay those credit cards. Her first mortgage with tax and insurance is $800 a month. So we talked her into renting this property. She can rent it for $1,900 a month. We're going to give her a loan of 30 grand to pay off her credit card debt. And that's going to create about a 600 or so monthly payment on top of her 800. So she's going to be all in at around 1,400 to 1,500. She's going to be able to cash flow this thing an additional $400, which she's now going to use to buy another rental property. So you're talking about, from a loan to value standpoint, she's going to be all in at roughly $80,000 on a house that's worth 210. So it's under 50% LTV. It's technically not a bailout loan. She's not in foreclosure. A lot of the leads we get are in foreclosure that look like this. So that'd be what we'd call the bailout loan. But in this case, the fundamentals are the exact same. The value's there. It's a great return, to our funding partners. There's a ton of equity in it, and we helped somebody really become a real estate investor while we were doing this.
So, Jason, as you do that, if we can step back just a second, as you go through that process, there's billions of dollars that has been raised for personal loans. Everybody gets marketed. Hey, you can go to this website. You can apply for a personal loan with your credit, with your good credit, and you tie in your bank account. And they're going to give you 25, 50, 75, 100 plus $1,000 at a high interest rate. They're called personal loans. And there's literally billions of dollars that have been raised for that, and it's being deployed all over the country. The difference between this, because this is really a personal loan, technically at first, for the person for her credit card debt. So say she owes 30,000, as Jason mentioned, she needs to pay off that debt. We're providing her a loan, but it's attached to a second lien position. So we're going through the whole loan process, the lien process, correct, through a qualified attorney that's local in that market. So the investor, whether we hypothecate the loan in with Silvercrest Opportunity Fund, it's being backed by the loan. That loan is a secured loan against the asset, correct?
Correct. Absolutely.
So that's the big thing. Like I said, a lot of people don't realize whenever you're doing a private loan to somebody, we're hedging it against the value of the house is the basics of it. And like you happen to mention, including the first lien position, the first lien mortgage, and the second loan, normally it's between 50 to 60% of the total value of the as-is value of the property. So that protects the investor that's in on the deal in case that borrower just goes and defaults on the second lien. They can cover the small amount for the first, and actually, worst case scenario, they would own the asset. If they pledge the capital against the fund, then the fund would take over the asset and resell the property over time. But the benefit to the borrower is they're getting cash to help their current circumstance. The reality is not 100% of them are going to pay off that loan. They could default. So we're sensitive in regards to what's the total amount of debt that the borrower has put onto the property. So everything's going to get verified through title. Title is going to clear all the lien positions so that we're properly placed with a lien position on the property in case something goes wrong and we have to take control of it.
Yeah. And James, another point here, especially on this one, is the folks that we are reaching out to and having these conversations with have a ton of equity they don't want to lose. Now, we are going to run into, a case where somebody just, washes their hands of it and walks away. But the vast majority of the folks are going to work with us, because we're calling them saying, hey, we want to buy your house, right? They're going to work with us in the capacity of let's get things sold. So we'll make the payment on the first and the second. While we're doing that, we'll do a JV agreement or whatever we need to do at that point. But the point is, most of these folks are committed to resolving the matter however it needs to be resolved, while trying to keep some of the equity. So in her case, she owes 180. In a fire sale, this thing's worth 175. A real estate investor who's wanting to rent it would probably pay 175 for it. So she understands, if you stop making the payment and you don't work with us, you're going to lose all that equity. And in many, many of these cases, they understand that, and they're willing to work with us to, at that point, okay, you can't keep it, you can't make it work, we just sell it.
I think these seconds are definitely super attractive, and it's important to understand you're not buying the second position and having to know all the bells and whistles and connect with the homeowner. We're hypothecating these positions, arbitraging the interest rate that's just below 20%, and providing you on a $30,000 position for a 3-year term, $300 a month passive as the passive lender. And we have enough sufficient equity cushion and arbitrage on the interest rate to be able to operate confidently that if that goes non-performing, we institute take back and pay off of the first, fix and flip the property, or JV with that specific homeowner. So, just to make that clear, that it's called a hypothecation. So we're pledging these assets, and if we end up going non-performing, you still have your position, because we pledged that second position to our capital investor at a $30,000 benchmark, and really say they wanted liquidity within a year, and we feel confident we have the availability to do so. That passive $250 a month, it may not seem like a lot, but for comparable strategies out in the market to earn an income, monthly, it's virtually non-existent. And especially with collateral, these are personal loans, in other words, collateralized personal loans backed by sufficient equity cushion here at mobilemailboxmoney.com. Do we have any questions this morning from anybody here? We had a couple people log in and log out this morning. This will go online, so feel free to go back and check out, the couple other deals that we went through, the deal structures, short-term lending. We've got annualized lending. We've got full 20-year seller finance notes that we didn't even discuss today. Just met a capital investor about an hour ago, and I think these seconds may be a great opportunity for Mr. Rodney Madison. So we appreciate you being here today. We'll probably send you maybe 1 or 2, Rodney, if that's something that you're interested in, as these are immediate available for you, if that's of interest at all. So encourage you to go back and view the podcasts, the vlogs, the masterminds, the unfiltered value. I just did a vlog at Azaria talking to a couple of real estate operators. I think I raised, $200,000 in the past 2 weeks. Sunny logged off for whatever reason, but she helped raise from our investors, as a liaison, a couple $100,000. Sean's out there working left and right, meeting investors. So we're active, providing our investors really the case unique opportunities that no one else sees in the marketplace. This is not stuff that you can just go find on the MLS. This is literally once in a lifetime opportunities that we're getting like 10 a month, 50 a month. So our raise in the fund will probably put a position for the seconds in the fund, providing a $10 to $20 million raise. We're currently raising $5 to $10 million for our seller finance note positions, and those are paying our investors accredited 10% for a 1-year term or 12% for 3. James, you got any last words for all of our guests here today watching?
I think what we're seeing as we meet with investors, Jason and others, is The high capital investors that historically, as we've kind of touched on, they've got the rug pulled out from underneath them that invested in syndications of apartment complexes. They're actually kind of circling back around right now and saying, hey, how can I leverage the capital that I have right now? Maybe I need to look at the foolproof program in comparison to trying to make the big hits with the apartment complexes. That obviously they got in 5 years ago and it's just not working out because interest rates aren't changing. But the new money is actually trying to be smart in regards to what their investment strategy is. And looking at other alternatives, Alden and I were just sitting, as he just mentioned just an hour ago, with an investor that invests in apartment complexes, and he's coming into the fund on the sole fact that he lost money in the last apartment complex deals that he's done through syndication because of that interest rate not changing. So that being said, that all that creates opportunity just as much as a hurricane creates opportunity. The hurricane in the real estate market is apartment complexes that were purchased 4 years ago, 5 years. They're in a hurricane situation and they're trying to figure out, what am I going to do? Because really, I have no income payment from that. And as Alden mentioned, some of those people are getting wiped out and they're not even getting their capital back. So they're looking for other safe locations where they can invest and have a safe, secure lien position and feel comfortable with who they're doing business with. And that's why we actually decided to do these weekly podcasts on Mastermind, to get other people's opinion and have them hear out what we're thinking about the market and what we're choosing to do as a company. We want to put it out there and see who wants to come along with us and invest with us, because we think it's a great time to invest in this market.
Yeah, James, along those lines, there's starting to be some really good opportunities again in the apartment space.
Yeah. So just because it didn't work, it's not working out, the acquisitions from 2020 to 2022, those people are in pain. And who's picking them up right now? Like Jason mentioned, they picked up a deal in Houston that's well underneath the market rate. And so that could be the new second set of investors that are coming in. But obviously, if they got burned on the previous apartment syndication, they're going to be a little bit more sensitive of, okay, really, is it getting to a bottom now, or is it going to adjust more? The reality is it's all based off of market rents, as well as what's the acquisition rate, the interest rate that you're paying for that monthly payment. So market rents are predicted to stay pretty much where they're at right now, and over the next 2 to 5 years could actually increase again due to the lack of new builds that are slowing down the development and permits that are going on for new builds. So we're seeing, even in Arizona, a rush of buildings being finished out and apartment complex being built out. But they're saying even here, there's almost a historical low of new permits being pulled for the new development for the next 3 or 4 years. That's really slowed down because what's being built right now was things that were getting permitted 2 years ago, and they're finally getting to be approved and to go up and being built. So it's just a cycle. It's an interesting cycle. And like anything else, you got to catch it and try to catch the right component that you want to invest in into your safe, secure investments.
What do we call that? We call that mobile mailbox money, making collateralized bank quality stability outside the stock market and contractually agreed upon returns and lean positioning, literal performing collateral, golden nugget opportunities here, brought to you by Silvercrest Opportunity Fund. We're here at 1257 here with our partners at Win Mobile Homes, Mobile Mailbox Money, and Silvercrest Opportunity Fund. Thanks so much for viewing. Go back and view the content. You all, if you don't see something that you like on our page, feel free to give us a call direct at 602-888-CASH. Rodney, I'll shoot you a couple deals if you like, and we'll go from there. Tune in next week, every Thursday, 12 o'clock Arizona time. If you're in the Arizona market, we're doing a 2 o'clock cigar meetup at Magnum Cigar Lounge tomorrow, August 15th. And from the 12th to the 15th, we got $30,000 going out to our investors. Little round of applause for our team. Appreciate you all viewing here today. Everyone have a great week, and we'll see you next week.
With you.